So, after a few up days in the market, what is the current state of affairs? Where do we think this thing is going for the rest of the year? Is the Santa Claus rally coming out? Who knows? But stick with us on today's Market Brief. Good Tuesday morning, everybody. Hope you guys are all having a great day. I figured that it would be a good opportunity to take a look at what are we looking at for the next few weeks to few months, right? We've got we're closing in on the last 6 weeks of the year, and really, the Santa Claus rally, is it in full effect, right? Did we see that happen when the Fed came out and said, you know what, we're going to pause the rising of interest rates, we're going to slow things down a little bit? Not sure if that's going to be the full effect that we see and how long that's going to last. All we can do is do our best to read the tea leaves, and by reading the tea leaves, I mean finding the money. What are the areas that Wall Street is saying, hey, we like this, we don't like this? What are the sectors that Wall Street's taking a look at right now? And how do we use that as an opportunity to kind of see what we're looking at? So let's today take some time to compare our major markets and then look at a little bit of the sectors. So let's dive into the charts here real quick. So the first one, the first thing that you see here is I'm looking at my four major markets. The S&P up here on the left, the NASDAQ on the upper right, the Dow on the lower left, and the Russell on the lower right. And what we are seeing is a one-year comparison chart, meaning what's the percentage change of each one of these to one another. So the S&P is up 14.69% over the last 1 year. The NASDAQ is up 38% over the last 1 year. The Dow is only up 3.87, and the Russell is down 3.97. So knowing the difference between these four, the S&P is really the bellwether, right? This is the one that this is the one that's going to tell us, okay, this is what the U.S. overall is doing. The NASDAQ is a lot more tech focused, a lot more tech heavy, and communication services heavy as well. The Dow are those mega cap stocks, and then the Russell are going to be the small cap stocks. So what does that tell us? Well, a couple of things. First of all, the Dow and the Russell are lagging way behind, but they're lagging way behind both for different reasons. And the Russell would be lagging behind because there's just not a lot of appetite for higher risk investments, right? If we look at the Russell over the last 1 year, we can see the Russell's down about 4%. But when the Russell went down back in early July or late July, it really, really fell hard because the appetite for risk was just not there for investors. And so because there was no appetite for risk, because remember, when the market does go back up, the belief that would be that the small cap stocks would be the fastest to go up because they're smaller and can move faster. Well, they can also go down faster as well. Well, what about the Dow, which is our mega cap stocks? If people don't want small stocks, well, wouldn't they want the really, really big ones? And how come the Dow is only up 4% over the course of the last year? I think this has a lot to do with interest rates. As interest rates have gone up, a lot of the Dow stocks are going to be some of those dividend-paying big companies that people want to invest in. But if my risk-free rate of return on the 10-year note is higher than the yield that these Dow stocks are paying, I'm probably going to want to go and invest in those risk-free rate of return than I am in those Dow Jones stocks. And so that's why I think we're seeing strong underperformance in both the Dow and the Russell. But let's take a quick look at the NASDAQ and the S&P. Now, the NASDAQ, very, very, very tech heavy. S&P also tech heavy, but does still have a lot of those large cap, mega cap stocks in there, dragging it down a bit relative to the NASDAQ. So what I want to do is say, where are we looking at for the next couple of days, the next couple of weeks? I'm going to go a little bit deeper. I'm going to go one layer deeper, and I'm going to use finviz.com. Has a very simple grouping section. So if you go to groups in Finviz, we can look at the performance of each of the individual sectors that are inside of Finviz. And in here, I can see the 1 day performance. I can see the 1 week's performance, 1 month, 3 months, half a year, 1 year, and year to date. Let's start on I don't really care about one day's worth of performance. That's certainly not going to be enough to tell us much of a story. But over the last week, Interestingly enough, real estate has gone up the highest, right? Real estate has been the highest over the last week. Well, not coincidentally, real estate has been taking it on the chin with the rising interest rates and the announcement to slow the interest rate rise, or matter of fact, the target to lower rates in the future. Real estate would benefit from that, and I think that's where we're seeing that money flowing into real estate over the last week or so. But a better picture is the last month. I'm very interested in the last month. And notice in the last month, utilities and consumer defensive have really been the leaders. These are the leaders typically in bear markets when people are looking for dividends. But we just talked about the fact that a lot of times what the Dow is telling us is that people on the longer term are not really utilizing those dividends because they're going to that risk-free rate of return. So how are utilities and consumer defensive so high? I think this was just a reaction to when we crossed below some key moving averages, which we've talked about on this channel before. And you know, if you want to see that, go into the Traders Army YouTube page and take a look at our reaction to some of the key moving averages. But we can see here that both utilities and consumer defensive are our leaders over the last month. The fact that there are leaders over the last month doesn't really mean that it's going to be a long-term thing, but I do need to pay attention to that because that right there says bearish market activity. What about the last 3 months? Well, look at the last 3 months. Real estate dead last, and that's due majorly to the interest rates that we talked about. Energy is the only positive one over the last 3 months, and I think that has a large part to do with the extreme increase in oil price that we've seen. But notice industrials and consumer cyclicals are down here on the bottom over the last 3 months. So when I look at this, this is actually still showing a bearish market picture. This is still showing a bearish market picture, even though we've gotten a short-term rally. Now, over the last half a year, over the last 6 months, notice consumer communication services and technology are off the charts. They are by far the highest. And the last 1 year, communication services and technology up 44 and 42% respectively. This is the AI boom that we are seeing, right? The AI boom. You know, the AI stocks that are just lighting the world on fire. You're going to get your Googles, your Metas, your NVIDIAs inside of these stocks. And these are the ones that are really just creating that strong bullish momentum. And so I think that if I want to be an investor, this is where I want to look for the longer term bullish opportunities if we think the market is going to go up. So now I need to go to the charts, and I need to go over to the charts and say, what does it look like based upon our most recent movement? So here's a chart of the S&P. All right, so we're going to look really at the S&P as well as the NASDAQ. And let's put these two kind of side by side because these are really our two most important ones. And let's just go to the last, we'll do the last 3 months or so. So looking at the performance of the S&P over the last 3 months and looking at the performance of the NASDAQ over the last 3 months, and let's compare those two to one another. And what I'm really looking at is the comparison of relative highs and relative lows. And when I look here at the S&P, I really need to pay attention to this swing high, which is the equivalent of this swing high in the NASDAQ, right? So both of these formed around October the 11th. So October the 11th is that swing high. October the 12th, is that swing high in the NASDAQ. In the S&P, it's October the 17th. But the NASDAQ, this swing high right now is a very strong controlling price. We did get a minor swing high right through here that has since been eclipsed by both of our markets, right? Minor swing highs have both been eclipsed on both of our markets. So my question would be is, what has been the interest level in this most recent move higher? Well, the way that I want to do that is I want to take a look at what does it look like in terms of volume, right? What does it look like in terms of volume? So I'm going to throw my average volume on here, and I'm going to make this go back to a full year. And when I look at the last year, this pink line represents my 50-day average volume. The last few days, we did have some above average volume on our rally here in the SPY. So our volume was slightly above average in here, a little bit below average yesterday on what I would consider a stall day, right? We stalled right here at an area of resistance. So we stalled at this level of resistance on a slightly below average, well, not slightly, on a below average volume day, right? And so that was one of our lowest volume days that we've had in almost a month. It was our lowest volume day that we've had in a month. And so that's actually a pretty good sign, because if we break through this resistance on increased volume, I believe that we will then continue to move higher. I think that's going to be the secret, is do we break through this resistance on increased volume? I think potentially more likely we're going to see in the short term a bit of a pullback, maybe even to this range, and then a better chance. And now if this is the case, what shape did we just form? That would be an inverted head and shoulders, a very common reversal pattern. Now that same picture in the NASDAQ, also very below average volume at a line of resistance. Could also be another potential of an inverted head and shoulders right here that we would be forming. And that inverted head and shoulders would come at an opportune time to allow price to then continue to rally higher. Looking at this on a weekly chart, we have gotten the pullback into a decent reversal area. So right now, I think that this is what I would call an inflection point. This is a very important point when it comes to pricing in the markets overall. And let's get rid of the price as a percentage. So that price on the NASDAQ is around 3. What do we have there? About 372. And then in the SPY, which is our ETF of the S&P 500, we're looking at about 437, 438. So those are the key areas to keep an eye on and to take a look at in your S&P and your NASDAQ. But that's all I have for today, everybody. I hope you guys have a great day. Happy trading. If you have any questions, send me an email, support@TradersArmy.com. Until next week, everybody, I will talk to you soon. See ya.